Today we're going to discuss the difference between the Opportunity Zone and a 1031 exchange. This is a tool we use to actually find the opportunity zones within California, and we can type in the address. This is a property that we sold to a buyer so they could take advantage of the opportunity zone. Here it is, Huntington Beach property. So what are the differences in the types of gain? 1031 exchange applies to the gain in real estate and businesses only. The opportunity zones, it can be real estate and businesses, but it could also be gain on baseball cards, Bitcoin that you sell, stocks that are way up, valuable art, a partnership, you're bought out from a company. All of those capital gains, we can mitigate the taxes thanks to the opportunity zone. Another major difference is how long taxes are deferred. So 1031 exchange, they're deferred indefinitely. You can hold on to that property or keep it rolling with more 1031 exchanges and keep deferring the taxes. For the opportunity zone, you will have a tax bill in 2026 or sooner if you sell before then. When it comes to how much you have to spend on the acquisition, here's an interesting difference. The 1031 exchange requires that you roll the whole net amount over. So if you have a property that you netted $2 million on and you have $1 million in basis and $1 million in gain, in a 1031 exchange, you have to invest the full $2 million or more. Opportunity zone, it's just the gain. So in that same example, you could take that $1 million out, invest the other $1 million in the opportunity zone. That is an interesting distinction between the two. A 1031 exchange does not require that you put any additional funds into the property after acquisition. The opportunity zone does. You're required to make substantial improvements. This property right here is an example. I helped my client acquire in the opportunity zone. He's making his substantial improvements right now. So they have different timelines for buying. 1031 exchange, you have 45 days to identify, 180 to close. The opportunity zone, you have 180 to close, and then you have 30 months to do those substantial improvements we discussed. So requirements for holding on to the asset. 1031 exchange, the IRS doesn't have any set requirements. You can hold that asset indefinitely. You can continue to roll exchanges. The opportunity zone, now you need to pay attention. All right, so you need to hold 7 years and you get a 15% reduction in capital gains. You're gonna owe your tax bill in 2026. Then if you hold the 10 years, that's where you get an additional bonus. The bonus being that the increase in value, the gain in value of the asset becomes tax-free. So you can see these start to add up and become a real bonus that help defer those taxes you would have paid way back when. So those are some of the key differences between a 1031 exchange and investing in an opportunity zone. Make sure you reach out to us to help you figure out which one you should be doing. This is not meant to be tax or legal advice. You're advised to consult with the appropriate professional.